Now let's hear from the people responsible for policy issues around this matter, people responsible for borrowing on our behalf, because they normally go there, they borrow on our behalf, and we are just told this has been borrowed, we have to pay, and as we have to faithfully give our taxes to make sure that we are servicing those particular loans. So we want to ask Mr. Daniel Ndolo, who is a director of debt at the Treasury, to just come and share with us his perspective, and perhaps tell us if we should sit pretty or if we are comfortable in terms of our debt level. Then we'll engage after that. Karibu Bwana Ndolo.
Okay. The chair spoke about that debt is likely to increase from 54% to 59% during 2018. And that is very possible only if you take a rope and put into the neck of the Kenyan economy. You make sure it doesn't live, doesn't grow. You strangle it, and then you let the debt grow, and then the economy doesn't grow. So while debt might grow, the economy will grow too, and therefore debt is not likely to be 60% by the end of 2018 as alleged. So I wanted to give that correction. There's been a caution, he spoke about a caution issued by the IMF, either in 2017 or thereabout, by some of the international, multilateral. But I wanted also to caution that the caution given by that multilateral organization, be it World Bank or IMF, was not on the debt level for Kenya. It was on the rate of accumulation of debt. They didn't say our debt is bad. They said, let's not accumulate debt very fast, because we might reach the red line pretty quickly if we go at a certain speed, which they spoke about. And let me maybe make a remark on what Mr. Ngujiri spoke about. You know, when he was speaking, I thought he's another civil servant from another department, whom I was really very happy to listen to, because he spoke the truth. Actually, our debt is not bad, as we'll see. And then let me also remark on the chair's attribution of the words of the CS that debt is not bad in Kenya. In fact, if you go by the same multilaterals and you go by the advice or the thresholds they have given, in fact, by implication, as we shall see, they are saying you can borrow 1.7 trillion more and you still be okay. We'll see why that is the implication. So perhaps let me start, but before that, let's go to the outline. I'll just touch very briefly on the A and the B. I give you more of the B, the size and structure of our debt. You'll excuse me, I'm bespectacles, but today let me stay without. So, and then we'll look at how Kenya's debt fare within the region. And then we go to the main subject, which is debt sustainability and the options. The Public Finance Management Act gives conditions under which a public institution in Kenya can borrow. Who can borrow can contract loans on behalf of the citizens. And then the regulations governing how to do it. That one is at your disposal. It is in the websites. And of course, those regulations and the law define what the national government can do, what the county governments can do. And it also spells circumstances under which the national government can guarantee public entities when they are borrowing. All this you'll be able to see. Let's go next. Governments borrow to finance budget deficits. That is when revenues fall short of the annual budget expenditure and then they borrow to cover external sectors' strength. I mean, for example, sometimes you may borrow not because your budget is not balanced, but because you want to have a buffer zone so that when you are under external pressure, you have foreign currency available for you to use to defend your own currency. So, and this is usually made available by the IMF. So that is what we call external currency support. But sometimes when you borrow those funds, you don't use them because they are for emergencies. Like what you have been reading in the press about standby credit, which has not been utilized so far because we have not come under any currency threat. Let's go to the next. This is where you'll be interested more to see, and this is where Dr. Iraki was talking about. If you look at the bottom part of the first column, you are going to see what the previous speakers were talking about, 4.6, that is 4.57 trillion, and that is the stock of your obligations as citizens or as residents of this economy. And this is divided into three. At the top is the stock of domestic debt, 2.2 trillion. And in between, you see a 2,205. That is the stock of central government or national government external borrowing. After that, you see about 4 components. But there's a line called guarantees, 129 billion. This is funds borrowed from abroad by public entities and guaranteed by the national government. When we talk about 4.6 trillion debt, it includes the 129 billion debt that is borrowed not by the national government, but by the state entities. And you may want to say those figures are big, but in according to which benchmark? So before we judge whether it's big debt stock or small or whichever, it's always to ask ourselves, what is the benchmark for looking at debt? And how do we fare, across our peers? In the next slide, you'll see the stock of Kenya's debt vis-a-vis other countries. And let me show you, because it's so tiny, you might not see Kenya's debt. Look at Kenya's debt here. And look at other countries. And you begin to say, maybe the people who manage your debt are doing a good job compared to these other countries. Let's go to the next slide. And we look at gross government debt as a percentage of GDP by country, and this is from IMF. You may have to struggle again to locate where Kenya is, but it's in the it's at the end of the first third of that list. We are not doing badly off, and this is about 50. This is in nominal terms. Nominal means you have not removed the effect of how money loses value of time. You have not brought it to present value terms. Although the debt is not repayable now, it shall be repaid in future, such that if you were to repay now, you will pay very little. Even without doing that removal of loss of value of money over time, our debt is still among the lowest. Let's go to the next slide to find out why our debt has been growing. Debt grows when your expenditures are perpetually or continuously more than your revenue. If the revenues were more, then you'll use some of those revenues to pay off debt. But in this country, it's only 1 or 2 times in our economic history where we ran a surplus budget. When when debt is not repaid over time, it piles up, and when it piles up, it has to be serviced in terms of interest. And when it is serviced in terms of interest, and you are not running a budget surplus, then it means you are also borrowing money to pay interest on the debt. So sometimes debt has speed, and it also has acceleration on its own, if left on its own, and that has had some effect on our debt stock. Let's go to the next one. As you are going to see in the next slide, the rate of debt accumulation as a percentage of GDP has been low compared to our peers in African region. Kenya's debt to GDP increased by only 28% between 2012 and 2017, while most of our peers increased relatively by a higher proportion. And the National Treasury has made deliberate efforts to diversify its sources of external debt. And that is why recently you heard about the Eurobond, which was the second time Kenya was going to the international sovereign market, capital markets to borrow. If you look at the slide, this slide, look at the first arrow pointing to Kenya. Kenya's debt accumulation rate over the last 5 years, 28%. Look at the last column. There's an African country, the one with the longest stick, Equatorial Guinea. Look at Tanzania, 28.1. Look at Uganda, 57. I don't see any reason why the media, particularly, would want to say debt is out of hand. In fact, they should be saying the positive things about Kenya's debt management strategies. And I'm not blaming them. I know sensational news sell. They are our partners in this. Together we can create a better picture about this country. Let's go to the next slide. Kenya's debt is, the path is approached from what we call the medium-term debt management strategy. We look at what needs to be borrowed in a particular period, like the next 3 years, and we look at what is the cheapest source of that funding. So we have a tool called the medium-term debt management analytical tool, where you put your needs into that tool, your stock into that tool, your needs for the next 3 years in terms of borrowing needs, and it will tell you whether to borrow domestically more or whether to borrow externally. We are going to see the difference between borrowing from domestic market and from external market, and why certain borrowing decisions have been made on behalf of the citizens of this country, and it's up to you to judge and maybe place a value in terms of those decisions. Let's go to the next one. As I said, I'll be brief on these narratives. Let's go to slide number 14, where we have debt sustainability. The public finance management regulations requires that our the net present value of debt should not exceed 50% of the gross domestic product. And this is a measure that has been well observed. Remember, this is not the nominal debt to GDP. This is net present value of debt, and that is how the law is written. That is, the present value of debt should not be more than 50% of the country's income. Let's go to the next one, and then we'll begin to see. Next, go to slide 16. The debt sustainability analysis. The debt sustainability analysis that is undertaken for any country's debt largely is composed of two aspects. That is the external debt sustainability analysis, to see how a country fares in terms of the stock of debt it holds. against external creditors, and the total public debt sustainability analysis. The first one, external, deals with only the debt owed to foreign creditors, and the next part of it is about the external combined with the domestic. If you go to the next slide, which talks about the external debt sustainability analysis, the analysis has found that although Kenya continues to face real risk of external debt distress, safety margins are narrower, meaning that the benchmark against which we can measure the sustainability of our external debt, we are approaching those benchmarks, beyond which then it will mean you would be able to borrow sustainably. Let's go to some numbers in the next slide that demonstrates that. This is an analysis of Kenya's debt sustainability, and the first column after the narratives gives you the thresholds against which to measure our debt. When we speak about thresholds, let us get to something else. In Kenya, what is the age at which children join standard 1? Normally, 6 years. So 6 years is the threshold, is the benchmark against which you can measure whether your child is overage or underage to join standard 1. So that is a threshold, a commonly established or used benchmark. Now, where you see thresholds, those are benchmarks against all countries in Kenya's category are measured. Now, how do we fare against those benchmarks of assessing sustainability of Kenya's external debt? The first one is that external debt should not be more than 50% to GDP if you are to remain sustainable. 50%. Look at 2017, 22.6. Look at projected 2018, 22.5. Projected 2019, 21.4. Projected 2026, 18.3%. Present value of debt to exports ratio. When you have debt divided by exports, and it's more than 2 times, which is 200%, then we say you are approaching a level which is not sustainable for the level of income that you earn from outside the country. And for Kenya, this is against 200%, it's 137 last year, 132 this year, 124, and you see the rest. What about present value of debt to revenue? Present value of external debt to revenue, benchmark is 300. We are actually not even 50%. We are far from that threshold. What about debt service to exports ratio? Public and the public guaranteed debt service to exports ratio. Out of 25, the highest we have been is 15%. We have a very big margin. This tells you Kenya can even borrow more from external sources and still remain within sustainable measures. Let's go to public and public guaranteed debt service to revenue ratio. They say the comfortable level is 22. I mean the maximum comfortable, 22%. The highest we have been is 12. We have a margin, we are able to borrow more from external sources. And this is the same message that Mr. Ngujiri gave, Dr. Iraki gave. And this is the same message which the chairman quoted of the cabinet secretary in earlier forums. So the story is consistent. Kenya's external debt is within sustainable levels. If you go to the next one, the next slide, if you go to the slide number 20. Yes, if you are, now if you look at these thresholds are the ones recommended by the World Bank. Third, if your debt, present value of public debt to GDP is below 74%, for a good country, strong policy country like Kenya, you are within sustainable level. You heard that we are at 53 in terms of nominal, 49 in terms of present value. So we are 49 against 74. And then the projection for outer years is less. Present value of public debt to revenue should not be more than 300. If you take present value of debt divided by the national annual revenue. Look at the numbers. Comfortable levels is 300% ratio. We are just in the 200s, meaning there is room to take more loan, but it's not being exhausted. We are not rushing to exhaust that. If you look at the bottom number, which is debt service, the amount of money you use as a proportion of the total revenue you collect per year, if you look at the threshold there, is 30. And if you look at the numbers for the next 2 years, 18 and 19, and last year, they appear to be marginally above. But if you go back to what I said, what I said about analysis by the IMF, it is said that we are at low risk of debt distress. The reason why they said low risk is because if you look at threshold 74, threshold 300, we are all at comfortable level. It's only this particular threshold in which the measures are slightly above. And the reason is this. Some of the loans borrowed in 2015, 2015, the first time we took the Eurobond, before we took the Eurobond, there was a delay. And therefore what happened, in order to finance that particular year's budget, there was a syndication of $750 million US, which was like 75 for 2 years, which was now coming to mature in 2017. Then in 2016, the similar thing, and some was for 2-3 years, another $1 billion US was for, last year was for 2 years, and that is what is mapping in 2018-2019, and that is what is pushing the debt service to revenue. But these are the loans now which have been paid using this year's Eurobond. And if you look at that payment of those syndicated loans which were contracted recently, short-term external commercial, they were heavy. And if you look at that and you divide, if you look at all the loans we paid off and you divide by the revenue for the last year, then this year, then next year, they are very heavy. They are very heavy on the revenue, and that is one-off. This is not something which is going to sustain in the medium term, and that is why we say Kenya's debt overall at the bottom. The results from the DSA indicate Kenya's public debt remains sustainable over the medium term. Let's go to the next slide. And this slide gives you now the full picture of Kenya's debt, how it will be in 2021, 2020 and 2022, and how it was as we close 2017. And this is a measure of the costs of the debt that we are carrying, and that we will carry up to 2020, 2021, and also the risks associated with the debt. If you look at the first line, it gives you how we closed the year in terms of nominal debt to GDP was 50.8, against, no, we don't have a measure, we don't have a limit in terms of nominal debt. The limit that we have is in terms of the next line, in terms of present value, 46.4 against 50. We closed the year within the provisions of the law. And if you fast forward to 2020-2021, with all the expected new borrowings and the expected growth of income, those ratios by 2020 it will be 39. Projection on the basis of projected GDP and the projected new borrowings and the stock that will be held at that time. If you look at, that is about the structure. If you go down now to risks, the financing risk, let's go to debt maturing in 1 year, where you see 23%. A quarter, we are saying a quarter of our 4.4 trillion debt matured last year. That is end of 2017. When debt matures, when a big chunk of debt matures in 1 year, it's not a good thing. But that ours was just a quarter. Because if it matures within 1 year, then you have to look for the resources to meet that maturing debt. Ours was just a quarter of the total stock, and largely that was from 50% of our domestic debt, because it's largely composed of treasury bills and a part of the previously contracted long-term debt contracted in the 80s, 90s, which was maturing in addition to the treasury bills. If you look at debt maturing in 1 year as a percentage of GDP, it was very little. If we were to use all a part of our income as a nation to pay what was maturing, it would just be 1.7%. Average time to maturity of the external debt, it is 9.7 years. If we were to stop paying debt to external creditors today, and then we calculate which is the longest period we can hold without paying, but when we pay everything, it will be in 2027 or 2028. That is about 10 years from now. If we don't pay, and we say give us a year to pay, on average, it will be 10 years from now, so it's long-term debt. If you look at average time to maturity, ATM, domestic portfolio, is 4.4%. What we are saying, even though debt is 50% domestic and 50% external, our domestic debt market, the lenders in this country are not able to lend long-term. There is something wrong about our capital markets. They can't afford to lend long-term in big ways. And that is a subject we are going to see in the next slides on what we can do about it. And that is also an item very intimate as to why Dr. Iraki was saying Japan has a debt of 250% of their GDP, and they were not complaining. US 105 or 140. If you look at the next item, average time to maturity of the total debt, that is the domestic and external, 7 years. 7 years, 7.1 years. If you go now to interest rate risks, the average time to interest rate fixing, meaning although we know how much to pay on our existing debt, the interest accruing to our existing debt, we are saying here after six years on average is when we shall get new rates. They might be lower, they might be higher, they might be the same. We are just saying, as a matter of risk measure, average time to refixing rates is 6.2 years. And then debt refixing in 1 year, the amount of debt that is going to mature, and therefore we get new rates to service that debt, or some debt mature and then you fix, or some debt as a provision in the agreement that after every 6 months or 1 year, within a year, if you add all that total, you are going to find that out of the 4.6 trillion debt, only about a third of that shall have an interest refixing, deciding on which new rates to apply going forward within this year, the end of this year. If you look at the proportion of debt with fixed rate, a rate that you are sure of, it is almost everything at 83%. Fixed rate. Fixed rate is always better for risk management because you are sure of what to pay, and especially if there is possibility of rates going up, so you are stuck with a rate that you are comfortable with. It's only bad when rates are coming down, when you feel like, oh, I should have waited to borrow when rates had come down. But in finance, there is nothing predictable. If there was, as Dr. Iraki said, that would be the collapse of finance as a faculty. Now, the last part of the risk is the foreign exchange risk. And foreign exchange risk or public debt is measured as a proportion of foreign debt as a proportion of total debt. And in our case, it is 50.4. Half of our public debt is in foreign currency. So we are 50-50 in terms of that exposure. If it was 100%, he will now do what he accused some people of comparing Kenya with Greece. And if we were 100% domestic, zero foreign exchange risk, he will say, let's go the Japanese way, let's borrow like there is no tomorrow. And all will be fine because you'll be able to use your own currency to pay without somebody saying, go to the market and buy foreign currency to pay my debt. Sorry for the numbers. But I think that is what Kara wanted the public to hear, and you are also representatives of the public. You wanted to be not really assured, but to be told the truth. Those are the numbers. Now, let's go to the next slide. This slide tells you the countries that have found themselves in the mess of debt. If you look at let me read the statement for you. No debt rescheduling or debt relief for Kenya. Other countries got relief and still have higher debt than Kenya. Now, this is the London Club and the Paris Club where debt was rescheduled. If you look at those years, those were the 90s, those were other regimes, not the current or immediate previous regime. So, under the current regime, no debt is in arrears, no debt is being rescheduled, and no debt renegotiation. And actually, according to the Constitution, obligation to pay debt is the first charge of our income as a nation. Debt repayment is not negotiable, and that is why when they went for the roadshow and they were floating just $2 billion, all the creditors were falling on their tummies begging to have a share of Kenya's debt, because it's the first charge to our resources. Not in any bad way, that's a good management. If you have debt, even if it's in your credit card, try to get rid of it. Make it your first charge too. Let's go to the next slide. And I think we are about to get to the options which we could look in order to make our good game better. And we are saying prudent debt put to proper use leads to economic growth. It helps sustain growth. If we borrow to fund high-impact projects where public revenues will not be enough, that's a good use of debt. And next, we say that National Treasury is fully aware that high public debt pushes interest rates up and affects everyone who wishes to borrow, companies, individuals. And high public debt may lead to poverty. The cases of Greece, what happens if you borrow from certain sources like external sources, and then your economic fundamentals depreciate, then the people who lend you money come for their money, whether they put the money in Nairobi Securities Exchange or to other enterprises like. So there is need to balance debt levels and the sources of that debt and economic stability in terms of interest rates, in terms of inflation, and the other aspects of economic stability. National Treasury is fully aware that high debt ratios may lead to accelerated debt accumulation. I say debt breeds debt. If you have debt and you don't eventually reduce your expenses, you'll have to borrow more to pay debt and also to pay the interest of the previous debt. So debt breeds debt. It may lead to widening gap on the balance of payments where you are able, if you borrow debt to invest, even if it's in a public utility kind of investment, and you are actually spending more that debt on external sources of equipment, and much of your national resources also to buy from outside, then you find that your reserves go down and you are actually at imminent kind of attack by currency speculators. And we say when debt remains high, like Japan at 245% of their GDP, US, Greece, and others, a big proportion of public revenues goes to service debt instead of socio-economic programs, and economic stagnation is brought about by public debt. That was Krugman in 1998. Next, we say National Treasury is fully aware that high debt ratios may lead to borrowing high cost. When people know you are in need of money as a nation, as an economy, let's say lenders, commercial banks will raise their interest rates. So it becomes, you put yourself in a situation where others take advantage of your resources or your situation. It strains the exchange rate, as we have seen. High debt is serious threat to economic development in general. There are many cases the world over. Dr. Iraqi spoke about some of them. Let's go to the next one. What are the options for improving on debt sustainability? We said our debt is sustainable, but what much more can we do to make our path better? Let's go. Fiscal adjustment is always the most important thing to do. If you find that we keep on accumulating debt because our expenditures are more than revenues, the surest way is cut down on expenditure. Look at the wasteful expenditure, cut down. I will not explain on that. It's self-explanatory. Cut down, save money, pay off debt. And then look for new ways of financing public investments, like public-private partnerships, so that the people who pay for projects under public-private partnerships are the companies that borrow to invest, and therefore the mwananchi, when the citizens consume the service and they pay for the service, now the money is used by the borrowing company, the investor company, to pay off that debt. So it's not through the tax way, it's through the consumption way. Whoever consumes pays. Or maybe the state can pay, depending on if there is a gap to stop up. Then paying attention, next, paying attention to details of debt packages. In most times, people sign off loans. Yesterday I was reading in the newspaper about some country, I will not name it, which bought fighter jets, I don't know, from Poland or someplace, and when the fighter jets landed, they found they were obsolete, they were not serviceable. They started now using those fighter jets to look for spare parts. They were not utilized. Meaning, if the need for fighter jets was still there, I don't know. I said, okay, thank you. It's Kenya? Oh, he's saying it's Kenya. So now, it means
If you still needed the fighter jets, you still have to go look for more money and buy. Meaning, when you are doing the deal, you didn't pay attention to what you are buying. That's the point. It's not even about the fighter jets, it's not about Kenya, it's about paying more attention to details of the package. So, all the way from project identification process to implementation modalities, be clear on expected benefits and the beneficiaries. Are the benefits to the borrower or to the lender? Those are important key questions to ask. Synchronize the terms of credit clearly. Key issues: who decides the projects and the project financing? Today's newspaper, I said, the Business Daily said, U.S. firm lobbies. Why lobby? I mean, that's the media. We should ask the media. So who is going to benefit largely? Those are questions you need to ask. And that is where public participation is very, very important. Forums like this, where you discuss issues like this, where you have your voice. After seminars like this, you also have memorandum to your representatives or to the institutions that relate to some of those things. Who is the project going to grossly on the net benefit the capital owners? Is it the locals who will benefit, or is it experts? Some financing terms may come with terrible terms and implications, especially where no transparency in credit arrangement. Next, invest in high growth sectors and social protection, not promotion of consumerism. If you are going to build a road someplace, there should be an underlying big economic reason, not just roads for cars. Why? Roads for cars, and no, he said the wagons are going to Mombasa empty. If you build an infrastructure somewhere, maybe in a place where there is no economic production, you are building a facility to help people import cars which may not really be helping you export anything. And in that case, and you are not a net manufacturer of cars, you are actually creating a market for the one who will export the car, for one who will export the oil, the one who will export the spare parts, and everything that goes with it. Sometimes mass transport, the train, may be better than the smaller cars that you want to create room for. Analyze the key results of debt-funded projects. Prosperity brings opportunities and challenges, but to who? Prosperity in the world brings opportunities and challenges, but to who and what goes to? If you look at the previous slide where we saw cars facilitated, if people were facilitated to import cars just to move around, go for holidays, somebody somewhere is making money out of that, and he's not with you. He's somewhere manufacturing headlights, the one which got broken when you came from a weekend of merrymaking. He's making another headlight to sell to you, but you are not making anything out of that, but you still have to spend. So the guy who is going to do that, his children are going to be happier. What will your children be doing when you are servicing, even tarmacking that road again? Let's go to the next. Take charge of setting priorities. Debt-funded projects are good, but for whose benefits? Locals or external corporate? Same story. When you decide this is a good project for us, ask who is us? The one hereby or the one far away? The one who financed or the one who borrowed? Next, let's develop domestic debt markets. And Dr. Iragi shall be happy to allow you, from an academic point of view, to borrow 300% of your GDP. Like Japan do, like US does. Why is it so? And this is what I said we'll come to. And this is where we saw the risks, foreign exchange risk of debt. When you borrow 100% and domestic financing sources reduces external debt vulnerabilities, domestic finance helps strengthen policy accountability and the country ownership of development strategies. And that is what we were doing with Emakiba when we introduced it. And that is what we shall be doing more as we support our local insurance companies, our local pension funds, our local commercial banks to lend more to government, so that whoever spoke about Buy Kenya, Build Kenya can now see the fruits of that. Let's develop domestic debt markets by targeting the diaspora savings through diaspora bonds, local currency foreign issuers. We issue in UK, but in Kenya shillings. Those who want to lend us in our own currency. Facilitate a lower cost of formal remittances so that we don't have to borrow, but put debt to productive use. If you look at that, chart there, Japan is, these are the 20 countries that highest public debt. And the reason why Japan is there is because they borrow, their public debt is largely in the yen. US, it is in the US dollar. UK, it is in the pound. Most European countries, it is in the euro. Next, continue to develop domestic debt market, because countries with well-developed domestic debt markets rely on domestic financing and are able to sustain higher debt to GDP. Similar chart, slightly different. No single, but remember there is no single cure for high debt problems. Next is take charge of selecting projects and align them to national priorities. The question to ask is, are debt projects outcomes consistent with the local needs or financial needs? The plenty in one place, because they're able to make money out of lending. What happens to our children? Next, take charge of selecting the projects and align them to national priorities, and ask the question, what are our problems today? Can they be solved through education rather than investing in, let's say it's a conflict. Let's say there is conflict someplace. Do you build walls or increase the number of policemen, or do you invest in education and eliminate that? Critical questions to ask. Dr. Iraki, I'm sure if you can pick some of these things and throw them to your colleagues, we get to see non-debt problem-solving approaches. Public participation is key in setting the national priorities and in debt contracting. As I say, look, ask yourself, what are our local needs? Maybe it is lack of education which makes people fight in over pasture and such things. Whose priorities decide whether they are priorities of the locals or the priorities of externals? And as you do so, locals should get involved. In conclusion, Kenya's public debt is at sustainable levels. Kenya's debt accumulation has been lower than our peers. Fiscal consolidation and development of local debt market is key to Kenya's future debt sustainability. Need to embrace alternatives like public-private partnerships, but beware of hidden cost of public-private partnerships. You have heard about the concessionaire asking for payment on this and that. PPs have their own risks. Improve on project selection. Debt should be used to finance select impact programs that benefit locals. Take charge of setting priorities, but priorities must be relevant to the needs of the locals and the local economy. Stakeholder involvement and public participation is paramount for continued debt sustainability. That is how I had under the current theme. I just give you one last slide about how Emakiba performed. Just one slide. Go down. This is just for public information. Emakiba, the first mobile supported public debt instrument issued, bond in the world was issued in Kenya in April 2017, and the total amount that was raised was is as shown there. The 247,750 was bought by 5,900 investors. During that time, about 300,000 people registered, but only 5,000 people invested. Although we targeted to reach the low-income non-banked population, it happened that 63% of the people, that is close to 4,000, brought only 70% of the 247 million. And they were investing between 3,000 and 10,000. About 22,000 of the 5,000 people brought in only 15% of total amount. Incidentally, the people brought 78% of that amount of money, 247 million, were less than 1,000. They were 908 investors, and they brought about 78, more than 3/4 of that amount of money. The lessons was Emma Kiba bond was largely taken up by the middle income banked population, contrary to the expectation that the Mama Bogas were going to participate greatly. So that was a great lesson learned. The next issuance will factor that lesson. I return the mic to the MC for further directions.
Thank you so much, Ndolo. It was difficult to stop him because some of the information I was giving is some of the questions we've been asking, so I wanted him to bring clarity. What I'm gathering is that all indicators are showing that there's no cause for alarm as far as our debt is concerned in Kenya. That is according to Ndolo. Maybe we'll need to have another forum to now discuss about how this borrowed money is being applied, value for money, and where it is being taken, so that we're able to be sure that whatever is being borrowed is actually being put to good use.